over 6 years. There we go. So I'll just start over. My name is Sean Bailey. I'm a investment lender. I'm a hard money lender and a primary home lender. I've been a licensed mortgage loan officer for about 6 years now here locally in Jacksonville, helping first-time homebuyers, veterans, and investors acquire properties. One of the biggest products that we are talking about today is bank statement loans. And sorry, let me take the mint out of my mouth. Um, Bank statement loans and how we can utilize them as investors and also just self-employed borrowers who are trying to get into primary homes. Bernadette, you had mentioned earlier that these bank statement loans are, from your understanding, only for primary homes, and that is not the case. We're using bank statement loans almost exclusively replacing DSCR loans with a lot of my borrowers right now, just because of the access and availability and how easy they are for qualifying factors that take the stress out of the DSCR loans that they may give you, which we'll talk about that a little bit later. Some of my key points here are: why do bank statement loans exist? How do they operate? Who's the ideal client or investor that needs to be, looking at these loans? How do we qualify, or what are the qualifying factors, and how do we calculate income? How do we, what are the different types of leverages, interest rates, and loan types that you can put on them? And then why is it better than DSCR in general? So why do bank statement loans exist? Well, it's for the self-employed individual who cannot get into, let's say a primary home or a normal mortgage loan, because, we're all business owners here. If we're doing our taxes the right way, we're claiming zero or negative income, even though we may be making hundreds of thousands of dollars a year. I even have some individuals that make over $1 million a year that are, doctors or lawyers that show negative $10,000 a month in taxable, write-off income, and they can't buy a house, and they have to save up for their taste, 500, 700, $1 million just to buy it cash, because they can't qualify on a normal Fannie Mae, Freddie Mac conventional loan product. With that being said, this is also still derived in the investment space for any DSCR product on our investment loan that has a super high loan amount. If you have a $750,000 luxury property, when you're going to a majority of these lenders, most of them will not be able to use short-term rental income for their qualifying purposes. So in this instance, bank statement can help largely because we're using your self-employed income and what money's coming in your accounts to actually show profitability on your debt to income ratio for qualifying factors on your investment property. So they exist to help the self-employed borrower to access primary homes or investment properties much easier using their income. What kind of product is this? It's a non-QM product, which is a non-qualified mortgage, meaning we don't go off Fannie Mae and Freddie Mac guidelines. We don't need the conventional speech of, we need to see all of your income docs, your taxes, your pay stubs, your W-2s. All we look at is your bank statements. If you are self-employed for at least 2 years, we can use up to 3 bank accounts, personal or business. And that sometimes is a large question with some individuals, because they go, hey, I'm not self-employed, so I can't qualify for this. Well, that also means, do you have a Schedule E on your taxes? Meaning, do you have any rental properties that you're claiming on your taxes? If so, you are now considered a self-employed individual, even if you have a W-2 job and you're managing a rental portfolio on the outside. So that's a big factor on who can qualify for these loans. Now, how do we calculate this income? We take, like I said, up to 3 bank accounts. It could be personal or business. And we take all the money that comes into each account. We're looking at either 12 months worth of statements or 24 months worth of statements. And any money that's coming into these accounts, We just divide it by 12, such as, for instance, I have a truck driving company that came to me about 6 months ago. The truck driving brokerage cash flows in revenue per month about $300,000 in cash flow coming into his accounts. Now, per month, what goes out is around $250,000. So their normal net profits are about their gross revenue. I guess you could consider it as being $50,000, not including what they're also going to be writing off on their taxes. So their taxes showed that they're making $5,000 a month. If you look at their bank statements, it showed $50,000 worth of gross profit. If we look at just what comes in the bank accounts, we're talking $300,000 a month. So how we did our expense ratio on this individual is that there was overhead, there's employees, and there's a self-employed questionnaire rather on what kind of business you're operating. Every business will have its own ratio that's going to be qualifying. If you own a waving arm inflatable tube man company, you're probably going to have very low leverage and very low overhead. So they're going to probably qualify you at 10% expense ratio, where we can use 90% of your deposits. Now, the trucking company, because it was a brokerage and the only employees are just sitting behind a desk, they're not an actual trucking company that are paying for the gas and paying for the mileage and everything that a normal trucking company does. Because we were running it through a brokerage, we got to use 85% of that monthly income, and we qualified this individual at $200,000 plus a month for qualifiable income. So we went from $5,000 a month based on their taxes and not being able to qualify for any primary home or investment property to literally having endless spending power on the bank statement income generation. So a large part of that is, that's why we do what we do. So those expense ratios and the money coming in is more important than what we're showing on our taxes. How we define that expense ratio is specifically what type of business you're running. I've had other people that generate $3 million worth of gross revenue, and we can only use 10% of that income because they have over 70 employees. So the lenders will take into account your business model, how many employees you have, and they kind of estimate what your costs are going to be running that business. Now, if for some reason they come in and say, hey, you're going to be at a 50% expense ratio and we can only use half of your monthly deposits, and let's say you are truly cash flowing more than the 50%, we can get a letter from your CPA to state, hey, their cash flow is, they only have a 25% overhead, not a 50%. And if we get that signed CPA letter, then we just add an additional 25% of your monthly income. So the leverages and loan types for this type of product, if you want to do as a primary home, which is awesome for a lot of self-employed, borrowers that write off everything and they do things correctly on their taxes, we have to be minimally at 10% down. So you can access the primary homes for bank statement loans at 10% down for a primary. Your rates and terms are not going to be the greatest at 10%. Because this is a non-QM loan, some of these loans that I've handed out I've shown these rates, much higher rates at 10%. Because on a primary home, on a traditional sense, if you put less than 20% down, you're not going to have mortgage insurance. So your PMI or MIP that's going to be involved on a conventional loan or FHA, anything below 20%. FHA, no matter what, but conventional, if you put less than 20% down, you have an additional $100 to $300 a month in mortgage insurance. Because it's a non-QM product, you will not have mortgage insurance on this loan at less than 20% down, but they supplement it with a much higher interest rate to where it balances out to almost be the same. So some people get scared at a higher interest rate when you're at 10% down on a primary. We may be talking in the low to mid sevens at 10%, which on a primary home is very high. Conventionally speaking, we're in the sixes. FHA, we're below 6%. So it is a much higher rate. But when you take out the mortgage insurance payment, it balances out to be almost equivocal. 20% down on primary homes, you're going to be right there, super competitive with your 20% down conventional mortgage rates. The other loan products that we have on this are going to be derived at short-term rental investment properties where we need at least 20% down for investments. And, we're primarily transitioning, and at least in my case and in my brokerage, we're replacing the DSCR loan with a lot of the product from bank statements. And I'll tell you why. If any investors in here, which it looks like Renee just showed up. I'm not sure if Renee is a real estate investor, but Bernadette, you probably know this. When we're qualifying and we, for a DSCR loan, most lenders are looking at long-term rental income calculations. There's few out there, and we have them, but rates and terms slide around for short-term rental income analysis. But 90% of all investors out there are going to be using long-term rental income analysis to qualify for the mortgage, which a DSCR stands for debt service coverage ratio, which means your rental payment has to cover 1-to-1 on what your mortgage payment is. Now, if you are not at 1-to-1 and you are negative cash flow, this is where it becomes a problem. You're denied. Your interest rate goes way up. We have to change loan products to a non-ratio DSCR loan, and it can get really ugly. And even though you may have a property, and it's really hard to qualify on DSCR loans now, because if you're anything over a $200,000 loan amount on a long-term rent schedule, your mortgage payment's going to be sitting around $1,500 a month. And on a $200,000 home, it's really hard to get $1,500 a month in the right area with long-term tenants. So when the appraisal comes back on a DSCR loan and the market rent analysis from the appraiser says, hey, we're at $1,475 and your mortgage payment's $1,500, we're blown out of the water. We have to change leverages. You're getting less cash back. Your interest rate goes up because we're negative cash flow, and it can really just disrupt the whole process. I don't know how many DSCR loans I've done in the last 12 months where we are, chomping at the bit to wait to get the appraisal back, 2 weeks into the loan process just to find out we're screwed. And that's not always the case. I mean, if you have current tenants in place and you have lease agreements that show large income that can qualify for the mortgage payment, DSCR is still a valid offer and a valid loan product. But if we want to eliminate the full stress of worrying about what that rental schedule will come back at and the appraised value, we can easily just go to a bank statement loan. So another huge perk to the bank statement loan is that it also has the DSCR qualities built into it. So if you have self-employed income and we're calculating your monthly rent, and if you don't have a lot of personal deposits and you're not a super big rental, have a super big rental portfolio or any Airbnbs or any self-employed income, let's say we calculate on a normal W-2 scale of like $2,500 a month. We put that up against your debt to income ratio, but also we will take the long-term rent schedule we still get the rental analysis on a 1007 during the appraisal, and we add that into your bank statement income. So we're still using the DSCR qualifying factor as a vessel into the bank statement loan. So we're adding that income in with it on top of your income. So it's honestly, if you have any money coming into any account, if you're employed or if you have any rental income or any bank statements that are just bringing in money, it's really hard to not qualify for this product because we're also using the investment income and long-term rent added with your personal income. So another huge perk. So that's why we've shifted to the bank statement. I don't like being that lender that says, hey, join our, come over here with the shiny rates and shiny program, and I quote you a DSCR, and then the appraisal comes back, and then we're, shot. Doing the bank statement loans, we have better rates, we have better leverages, we have, lower seasoning options, as well in some cases, and a lot more flexibility to buy more properties one after the other. And once we qualify your income one time, we don't have to do it over and over and over again. This isn't a per property specific thing. A lot of my investors are coming in at $100,000 a month of bank statement income that's already been proven and underwritten by the lender. And it's like, okay, well, hey, their buying power now becomes 20 different properties because we're adding the rental income for every new property on top of her $100,000. And it can just steamroll into, once you have your income verified and calculated, we're just steamrolling into more investment properties and not having to worry about what an appraisal is going to say that how much money you should make on the property. So, we have shifted over to the bank statement world specifically to eliminate the worry and the cause of my preface to every borrower saying like, hey, things may change halfway through the process. Once we get this appraisal back, we are liable to shift rate, to change leverages, and so on and so forth. Now, hey, what we are with a bank statement loan, I know what your income is before we even, submit your deal. Your rate's not going to change, period. And we can lock you in and just get you closed. So that's why we use bank statement loans. They're great. Like you said, I mean, even primary home buyers who are self-employed. I was dealing with a short-term rental investor out in Ponte Vedra. We're doing a refinance, cash out refinance, 80% on a short-term rental that she owns. And I was telling her about bank statement loans. We're fully qualified. I mean, we're, on our way to closing her down. And she was like, I wish they had this product for primary homes because we can't buy a house. And I was like, what are you talking about? We can totally buy a house. And we just sent her a pre-approval for a $1.3 million primary home. And she's about to get under contract because, her and her husband, who are doctors, who make a large amount of money, but they do their taxes right by buying short-term rentals, doing the cost segregation, writing off everything on there that we don't have to worry about what our taxes show. So, even investors like this can buy primary homes at comparable rates at 20% down.
Okay, so that is a lot of nuts and bolts. That sounds like a really good package. It's like the best of both things tied together. And, when you were saying higher interest rates, I was thinking you were going to come out with something like 9% or whatever. But,
Oh, no.
Historically, 7% interest in the sevens is excellent prime rate. If you go 20, 30 years span,
No, it definitely is.
People got a little spoiled with the little 3 and 4% rates a few years ago, but 7 is not a bad number. It really, and I think if people look at the difference between 6 and 7, they'd be a little bit surprised. But it doesn't look like we have a lot of attendees.
No, just all my people.
And then one other person right here, Zoom. It just says Zoom user. It doesn't really say their name.
That's Morty.
Oh, that's Morty. Of course it is. All right. Well, if nobody has any questions, it doesn't look like we have a big field for questions here. I think that this recording is going to, go to my YouTube and it's going to go out, but with I think we should package some marketing with it, Sean, to where it clearly, like in the headline, kind of,
yeah, I mean, we could send it over.
I can send it like the better, like I hate to say better, but like what's the more competitive loan for investors than a DSCR, something like that. Because I do think a lot of people are under the impression that this is for primary properties only, whereas your person thought it was for only investment properties.
Yeah.
So I think that is something that really has to get out there so that people know that this isn't just for a primary, or also that they can use it for a primary, but the advantages to it versus taking out DSCRs as well. So,
yeah, I mean, and DSCRs are still great for like lower loan amount homes. If you have a $150,000 property, it's getting a DSCR just fine. We can keep it at the DSCR. There's no reason to give me all 12 months of your bank statements and do the calculation. That's one fear that I think some investors have, is where they go, hey, I don't want to do all this documentation stuff. But it's really not that much. Just go to your online banking, click all of your statements, just save them for your PDFs, and that's it. Everything else remains the same. But yeah, I mean, It's just helped drastically in our world dealing with a lot of the luxury short-term rentals that we're refinancing, where we have a 2.2 and a $2 million loan amount that, I don't care who you are, if you're not using short-term rental income analysis with certain lenders, you're not going to qualify on a DSCR loan.
So can they do a package loan with this product, or is this a per property? Say they wanted to put an offer on 3 different investment properties. Can they do that under one loan? Is it 2 per
No,
loan?
they don't have a portfolio loan for bank statements. I'm sure there's some lenders out there that will use a hybrid income, with DSCR and bank statement, like on a self-qualifying factor, but those are probably going to be vested not under an LLC. So I wouldn't suggest them, but no, your portfolio loans are still going to be DSCR managed and leveraged that way.
All right. Well,
yeah, if you want to send me this recording, Bernadette, I'll fire it off to my marketing guy and he can do snippets of whatever. And
yeah,
we'll do it that way.
I think, having some like highlights screaming out about different things that you mentioned and why a lot of people who previously were using DSCR loans are shifting to this instead, what the advantages are to that. I think that's what's going to grab a lot of attention, because I don't really, as far as I don't know that a lot of people realize that, and that they're, that this is something that they're really like dialed into. So, yeah, let's do that with it for sure.
Yeah. Cool.
All right. Well, you guys, thanks for attending, Anita and little Mr. Incognito, and y'all enjoy the rest of your week.
Absolutely. Thank you guys so much. Appreciate you.